Let me first apologize that the lack of formulas in the next two presentations, but we will try to make it as interesting and stimulating to you. Second, I want to revive a very small piece of Chinese tradition, in particular those traditions that's unique to conferences held in China, that every speaker, when they come up, they will thank their 领导. It's very hard to translate into English who and why he is a leader, is a 领导. But I think on the surface it means somebody who is the boss. But I think deep down it must refer to people that you respect. So on behalf of all the alumni who are here today, I think we should thank the Dean, Professor Jiang, Professor Ross, Professor Merton, Professor Pan, and Professor Lucas, traveling 10,000 miles to Shanghai and hold this wonderful conference. So without further delay, let me introduce Dr. Huang. As mentioned, he is the Managing Director and Head of Sales and Trading at CICC. Previously, prior to CICC, he had a long experience with IMF and London School of Economics and various institutions around the world. And he published regularly in a number of academic journals around the world.
First of all, I would like to thank MIT Sloan School for inviting me to participate in this discussion today. MIT, of course, is very famous for being the birthplace for modern finance. I'm a student of modern finance, so I think that certainly I benefited a lot. Although, last night as I told the dean, I did not really graduate from Sloan School. So my role here is, Daniel gave me this role. I will be focused on my discussion on the public market side of the Chinese market. Okay. I have a few slides I want to show you. But before I go to the slides, I think that given that the theme of today's discussion is the finance for the future, and MIT, of course, is very famous for being the birthplace for modern finance. I would like to say that China certainly is moving towards apply the tools of modern tools of finance, and trying to get into the frontier of finance. When they famous, probably the most famous formula in finance, of course, is Black-Scholes model, was written. I guess in China, no one understood it, or no one even knew it. Okay, that's where China was coming from. I guess that when Professor Ross's APT model was developed, maybe 20 people in China knew what's going on. Okay. When Professor Wang's work on liquidity was written, I guess that in China probably over 100 Chinese understand it. I was one of them because I read it. I was in a graduate school, so I was my supervisor asked me to read that paper. So I think that if you think about for the last 5 years or even now, MIT Sloan School also has a Master of Finance program. I was told about 50% of the students came from China. I think that now in China, probably, this is my personal estimate, maybe 20 million students and financial practitioners know the name of Bob Morton, Jiang Wang, Steve Ross, and others in that kind of combination. So in a way that China came a long way from knowing nothing about modern finance to basically knowing basically those famous names in finance, and a lot of them came from Sloan School. So I think that that's also give us a hope about where China is getting into. So I'm going to show you a few slides. Hopefully that will also give you some background about where China is, and hopefully will give us some prediction about where China is going to. Can I get the slides? Okay. I prepared a few slides on China's public markets. okay? China came a long way, as I said, okay? When the famous Black-Scholes modern model was written in China, as I said, no one in China understood it. The reason is very simple. There's no markets in China. No single stock. The stock market is really relatively in the People's Republic of China, a new thing. Shanghai, of course, was famous as one of the leading financial centers before 1949. But basically, after 1949, everything was shut down, okay, pretty much. So only from the 90s, China started re-establish two markets, one in Shanghai, one in Shenzhen. Of course, the Hong Kong market was going on. So basically, as of June of 2013, which is, I think is updated data, there are about 2,578 companies listed in A and B shares, okay? This is not including the Hong Kong market. I'm going to talk about the Hong Kong market later on. In terms of market cap, it's a little over about this is 3 trillion. Okay, that's the 3 trillion US dollars. Okay, that's kind of matter, and roughly about 40% of China's GDP. Okay, that's over the years. Okay, when China started to open up, first of all, established the market in Shanghai and then in Shenzhen. And actually, if you look at the kind of public stocks, they are getting more and more complicated. We have A share, which is the main book, and also we have B shares, okay, which is basically traded in foreign currency. Then, of course, we have this Hong Kong market. Hong Kong market, basically, we have this many H share, and also we have red chip, okay. In addition, a lot of Chinese companies over the years managed to be listed in New York, okay, in NASDAQ, and also in ADR, and also in Singapore, in London, and even in Canada and in Germany, and also in some other kind of offshore places. Okay, so you could find Chinese companies listed all around the world. Okay, which is really an interesting phenomenon. You can trade China outside China, you can trade China inside China. Okay, of course there are other mechanisms allow you to trade from outside China to China, so-called qualified foreign institution investor QFII, and recently there is a renminbi QFII, RQFII. Okay, so market is developing very fast. This is the mainland capital market in a way that over the last 20 years or so, as you can tell, I went through a very rapid development. The peak in terms of the market index pretty much reached at 2007. After 2007, 2008, we know that there is a crisis. The market rebounds somewhat, and currently the market is in a way that is still trying to find, I think, that, a floor. Last 3 years or so, the Chinese domestic equity market is not doing that well, relatively speaking. It's one of the probably, one of the worst market, not as the worst, okay, emerging markets. Actually had a kind of negative return if you look at the index over the last 3 years or so. Meanwhile, if you are doing trading, I'm in charge of the sales trading department. I think that the trading volume stabilized and even went up somewhat. Meanwhile, that if you think about smart investors, I think that a lot of smart investors over the last 3 years made a lot of money out of the Chinese market. Okay, of course, one way is to short the Chinese market. Okay, you can also make money there. Another way is that you find very good companies. Most of them actually are listed in Shenzhen Stock Exchange, not in Shanghai. You know the reason. Okay, we come back to the reason. I think Shanny probably will talk more about that, the reason later on. Okay, so in a way that in terms of the capital raised over the last 20 years or so, it continued to rise. Okay, and the peak pretty much reached first of all in 2007, then later on in 2010 and 2011. And this year, so far in domestic market, I think that the IPO market is more or less dead. Okay, and we hopefully the market will open up. In Hong Kong, the market is open, but it's not doing that well. Hong Kong, in a way that it by itself plays a very important role in China's capital market development. Over the last 20 years or so, China's market developed so fast. I think that for several reasons. One of the reasons, as I said, there are many Chinese students, myself including, Jiang Wang including, we all came from science and engineering background, somehow end up in finance. There are many of the students following that kind of track, and Jiang is a role model for all of us. I guess that, so in a way that there is a lot of interest in finance, okay, from the younger generation. And also that the raising capital is also very, very important for the state-owned sector and for the private sector. Another very important factor, I think, for China's very rapid market development is really that China has Hong Kong, okay? The Hong Kong market has always been there. Hong Kong market adopted to international standards, international rules. So in a way that after China started to implement this opening up reform policy, Hong Kong market become a very important part for China's own financial market. That's why the H-share market, in a way, that play a very, very important role. Indeed, most of the large state-owned enterprises were first listed in Hong Kong market, then listed in Hong Kong market, in Shanghai market. So there, I think that Hong Kong market play a very, very important role. In terms of the total amount of fund raised, as we all know that 2010 was a peak. There that Hong Kong raised almost 900 billion US dollars. Hong Kong IPO was ranked #1 in the world, and actually was ranked #1 in the world for 2 consecutive years. It raised more funds than London, than New York. Okay, so most of that, of course, is from Chinese company, and recently also they invite other companies, companies from other countries, including from Russia and from Asia, from other part of Asia. In terms of the IPO market, trading, all that, I think that we do see a rapid development. Okay, but really, if you think about the whole securitization process, I think that China is still lagging quite behind major markets. In particular, lagging behind the U.S. I think that also lagging behind some of the European markets, London market in particular. Okay. In terms of trading, I think that I will talk a little bit about trading. I think that the market turnover in China is much faster. Okay, the Chinese market, in a way, is still dominated by retail investors in terms of trading. Most of the activity came from the retail side. Institutional investors increasingly, become more and more important, but still in a way that if you really do a measure, we don't have good statistics for this. I think that really that they play a much smaller role than in Hong Kong. And Hong Kong, even in the Hong Kong market, institutional investors play a much smaller role than in the U.S. and the UK market. I think that's basically is a simple characterization of the in terms of the market investors. Okay, I talked more or less the same thing here. Also, that I think that there are other problems. I guess that we will have opportunity to discuss these problems, including with the audience. One of the problems I see is really that in terms of Asian market, the access, in a way, there is no really good access mechanism. Delisting is very hard. Okay, so in a way that when a company manages to get listed in the market, is even if the company is not doing that well, it's not so easy to really to delist it. And also that even a good company, okay, after a few years, that a company has a life, is right? Maybe you want to go private, okay, which is maybe an optimal strategy for the investors, for the shareholders. But in China, that's also much hard. Okay, so I think that that's one of the key areas that we believe that probably that China should develop further. There are other problems I think that we'll discuss later on during the panel discussion, including further improve the corporate governance structure, which is very, very important. including, of course, to improve the accounting and the information disclosure. I think that we also see issues that China will need, basically to develop further. Another feature, I believe, from a secondary market perspective, that investors are a little concerned, of course, is that Chinese companies, in particular large state-owned enterprises, they are reluctant to pay out dividends. Okay, I think that's another feature. So they basically try to use the market to raise more funds. Okay, they will be willing to basically to issue additional capital and share whatever to split the shares, doing all kinds of things like that, rather than basically paying dividend. Even the company really is making good profit, maybe the growth potential is not that good. Okay, I think that that's basically somewhat inconsistent with what we understand what financial market or finance should do. Okay. I say just a couple words about another very important market, which is the fixed income market. Fixed income market in China, in a way, is relatively speaking, I think is even less developed. There is even a longer way for China's fixed income market to catch up. First of all, the size is not big enough. But more importantly, really, the market are segmented under different regulators, and in a way that it's hard to try to bring out the liquidity, among the markets. And I think that there are other kind of structural issues, which is related to really the partly regulation, partly the function of the market. In particular, how you basically get the liquidity out of the market in a difficult situation. Recently, I think that you probably all noticed that the Schiphol instance, on June 19th and June 20th. I think that that's going to that's basically some people say that it's a stress test. I would rather not see such a stress test. Okay, from a market practitioner perspective, but I think that it showed that really that when there is a liquidity issue there, and the issue can be quickly, amplified into alarming level, which is really, we show that in terms of the market infrastructure is still lagging, and also that I think there are a variety of other reasons behind that. But I would rather to leave my time to Mr. Shan Li, and also to to the chair to maybe we can discuss some of the issues later on. Thank you.
Thank you, Haizhou, for giving a wonderful overview of the market, and in particular the challenges the domestic equity market faces. I'm intensely curious about Li Shan's new title, because he holds the title Chief International Business Advisor to a very unique Chinese institution, China Development Bank. But before he disclosing the secrets, he will share with us how he makes money in private equity.
Yeah, good morning, everybody. While Dr. Huang shared with you about the big picture and public market, I would like to use my personal experience, both as a student at MIT and also as a practitioner in an emerging market in China, both as an entrepreneur and an investor, to share my experience as a private equity in the industry of private equity in China. Let me start, since it's an MIT firm, as Professor Ross said, we will start with some equation. So let me start with the theory. I try to remember what I learned at MIT almost 20 years ago. Private equity, I think, fundamentally is starting from this theory of corporate governance. As everybody knows, as a separation of ownership and control, we have this famous agency problem, managerial insider control, right? The principal agency problem. In business school, we already talked about Michael Jensen's free cash flow theory, or free cash flow story. Basically, talk about how managers not really fulfill the obligation to the shareholders. As a solution, people propose so to have large shareholders. Because if we only have small shareholders, like in public market in China, then you will have famous free rider problem. So you need a large shareholder which is both has an incentive and ability or rights to monitor and motivate the managers, the agent. So based on that theory, the reason I studied that theory at MIT almost 20 years ago is because right after the big wave of LBOs in 1980s in America. That time, there's lots of debate. If you read the Wall Street Journal or those social media, they will think Wall Street is devil, basically. But the academics, including many professors at MIT, they use this theory to justify, to advocate the LBO, MBO trend in US. So I was deeply influenced by that theory, and actually my dissertation is focused on that area. So I feel private equity will be a good channel of financing to economy, or especially to entrepreneurs. So when I returned to China in 1998, that's the first time I joined China Development Bank, because as a kind of patriotic behavior, I decided not to take any salary from CDB. So how to live in China? So I decided I found a partner, my former classmate, schoolmate at Tsinghua University. So we started a very little company called SoFund.com. Okay, when we started the company, we only have about $20,000 US. Okay, but we have a bigger plan. We want to immediately build the largest real estate portal in Greater China area. So we need money. So I remember my theory at MIT. I think, of course, stage one for startup company go to a venture capital firm. So I started shopping around. That time, by the way, there was no Chinese venture capital firm. It's all the players are foreigners. So I talked to Warburg Pincus, talked to Goldman Sachs, talked to IDG. So eventually we got a couple million US. So that's really critical. Without that money, we wouldn't be able to start it. So the first time I see the benefit of venture capital for entrepreneurs. Right? So gradually, then we move to the next stage. So we want to go to strategic, so-called strategic investors. So we talked to Telstra, the largest telecom player in Australia. So they came in. That time I believe in kind of. I think the principle should have a large shareholder. So we sold 50% of equity to Telstra. But that creates a problem. We have 50-50 ownership. We have, largely I think they are very supportive and they really want to build our business because they have a very big stake. But this is China, it's an emerging market, very much different from Australia. So we have lots of managerial issues, put it that way. To solve this problem, so I remember, the reason we have MBO in US is when the shareholder and the manager has some problem. But that case mostly because we want to use the MBO, give manager more incentive to align the interest. So I think we should follow that path. But we already, we cannot, find another private player which can take us. We are a private company, but I think they cannot basically buy a major stake from us. And also there's a valuation issue. What's a fair price to do this? So we did kind of the reverse. We are doing MBO, but not through typically American way, which is through privatization. We did a reverse. We did going public. We listed the company SoFund, New York Stock Exchange. In the process, we let Telstra sold 100% of their equity. And at that time, we invited large private equity funds like General Atlantic Partners to be our new shareholder. So through the public process, we regained the control by the management or better alignment of the interest of management and the shareholders, including the public shareholders in this case. So this is a full circle of the growth of SoFund.com. I think it fit very well with the theory I learned at MIT. And it turns out that SoFund became the largest real estate portal in the world, actually, not only in China. So even in this very depressed financial market, we still enjoy a market cap of over $2 billion. So after the initial, I say, success of being an entrepreneur to apply this kind of private equity theory to practice, I started to think about to become an investor, become a general partner, to invest in other companies. So at the end of 2005, I quit my job as CEO of Bank of China International to set up my small firm called Sunshine, means 3 mountains, because I had 3 partners. At the beginning, we think, oh, it's I had the experience to manage large financial institutions in China, work at Goldman Sachs, Credit Suisse, Lehman Brothers. I said I had enough experience, as well as collections in China. And I have a kind of all-star team. We have a former president of Goldman Sachs and a former partner of Fortress Capital to become my partner. I think it's an easy job. But I really know the bigness in this emerging market for private equities. Our first failure is in Chongqing, that famous city in northwest China. So we wanted to privatize. I always remember buyout, LBO, always have this kind of theory in my mind. So at first, I want to privatize a bank. So we talked to the mayor, talked to the party secretary of the city. We want to, get majority control of a local commercial bank. We did get the support from our government. We almost there. We agreed to acquire 90% of a city commercial bank, which, if it happened, would become historical in China. But what happened was suddenly China changed its regulation. It doesn't allow any US dollar private equity fund to take any shares in your Chinese commercial bank, which become illegal. Our term sheet become illegal, so we gave up. So we named our lesson number 1. Emerging market, regulatory framework keep on changing. Right? And then this kind of lesson again and again. This is the first one. The second lesson, I said, okay, we are not allowed to invest in regulated industry, like a financial service. Let's go to the business I'm familiar with, which is the internet, because SoFi is a leading internet company. So I found another company in this city. It's a famous company called PPG. Okay, it's founded by somebody, studied in another business school, which is not MIT. Okay, so we had the investor like KPCB. Yeah, we get Jeffco from Japan. We got all those famous names, put their money first. I think this is a fit. I look at the business model. It makes sense to me, through my own experience as an entrepreneur. So I invested, okay? And actually, even that time, Goldman Sachs came to me and said they will do IPO. They give a very big valuation for the potential IPO. So I think this may be another SoFi for me, okay? But end up, the founder, the chairman, CEO just disappeared. Okay, he took the money and ran. We couldn't find him. Okay, given China's legal structure, we cannot even find a way to go after him. This is number 2 in an emerging market, right? You may not be able to trust the entrepreneur. Not everybody, like my partner, the CEO of SoFi.com, Vincent. So that's number 2. The third lesson, I say, okay, let's go global. The emerging market is kind of too tricky. Let's at least have kind of global LP base, so we have more resource. So I team up with another company, which also founded by my former colleague at Goldman Sachs. So we try to get some money from Europe, from Generali, the largest insurance company in Italy. So everything seems well, like 2008, when financial crisis started. We were talking about raise $1 billion fund. Myself become partner who have an office in Beijing, in Hong Kong, in New York, in London, and Paris. Truly global, and we have huge money, and the valuation, because of the financial crisis, is coming down. It's a good time to hire people, good time to invest. I said, thank God, finally. In Chinese we say no more than 3. The third time I will succeed. But I failed again. The reason? Because of financial crisis. Not only the valuation of the company going down present a better investment community opportunity, But at the same time, the LPs, the investors of fund, they also lose money. They don't have money. They withdraw their commitment. So my company basically on edge of bankruptcy. We don't have money to manage. So after three, so this gives me this number 3. The world is flat. When I smiling look at the financial crisis in New York, I didn't realize the storm is approaching me, approaching my company. So after 3 failures, right, I finally become much more humble, much more realistic. And also thanks, our UBS CEO is here. They offered me opportunity to become vice chairman for investment banking at UBS. So give me some comfort to support me to fight, continue to fight, okay? But at that time, but I don't want to give my hope or dream to build up private equity. So I'm trying again. Because of my 3 repeated failures, I don't have the credibility to raise money in US dollar market. So I have to come, again, emerging market, I talk about all the risks, all the problems. On the other hand, it's an opportunity. In this emerging market, the investors, they don't look at the managers of the private equity fund the same way as established institutions like Coppers, like all the Western LP institutions. They look at probably what's the potential rather than the track record of this management team or this manager. So I got the opportunity to talk to the company right next door, Ping An Insurance. Right? I said, let's raise the RMB fund. Rather than focus on investment in every sector, like most of the private equity firms did in China. They said, I'll follow my success of SoFund, which is a vertical focus on real estate. When we started SoFund, we have other like Sena, like Sohu, they kind of portal provide all kinds of information. We do, when we start SoFund, because late, so we start to focus on one sector, which is real estate. Turns out it's a success. So I learned that lesson, so I told Peter Ma of Ping An Insurance, I said, why don't we start something focus on energy and natural resources? Because for this sector, we have 2 advantages. One, exactly, I remember my lesson number 1. Certain industry in China was restricted. It's not allow foreign private equity fund to invest. But how about, but on the other hand, you look at the other side of the coin. When you say the RMB fund, so you can invest in a certain area which US dollar fund cannot invest. So that's, you turn this challenge into opportunity. So if we focus on energy, which is like many, is considered a strategic sector for any country, right? So foreign private equity fund is not allowed or not capable of make a systematic investment in China. Okay, so if we start an RMB fund, so we don't have this competition from major global players, at least for now. First, that's one thing. Second, they look at the economy of scale. Because energy companies, in China, energy, most of the coal companies, which 70% of Chinese coal, both in terms of supply and demand, are 70% of coal. But coal companies, are all very capital intensive. So when you invest in a coal company, you need to put in lots of capital. For example, one company we invest, we put in 1.8 billion RMB just for kind of minority stake in that kind of investment. Because China's RMB fund industry just started, if all of the RMB fund at that time didn't have lots of money, they are not able to invest systematically in this sector. So I think energy and natural resources, on the one hand, you don't have the competition of people, foreign players who have deeper pocket. And for the domestic players, you don't have money to compete against you. So we decided to focus on that area. So about two years ago, we set up China Stone, which is a joint venture of my company, Sunshine, and Ping An Insurance. We started to invest in this sector. So far we made 5 investments, and the largest one actually is also in Shanghai, which I again applied my theory and then at MIT, which is basically most typical private equity in the US is kind of buyout fund. it's for large investment. You do majority control. As many people know, in China it's very difficult. Even KKR, they do mostly focus on minority investment. But finally, we got up to in Shanghai to do a majority, not only majority, actually do a 100% privatization of a famous state-owned company in Shanghai called Jiahua. So for that single deal, Ping An and China Steel put up over 5 billion RMB by the 100% of the equity. So that's my experience. You can tell how challenging in this emerging market to do private equity, and also how much opportunity it has. Thanks.
Thank you, Shan, for sharing wonderful story with us. And I've been to many speeches, mostly on success, but your 3 failures, I think, inspired all of us even more. I think not only MIT is famous for finance, but also I believe MIT also invented venture capital. So there's a good connection here. So we now open the floor to questions.
Me again. And dear panelists, and I have 2 questions. One is more general. There's a saying, a little bit playful and cynical remarks on the internet that there's 3 populations really make some really serious contribution to the Chinese development. These are the peasant population, the stockholders population, and the internet population. And what's your comment on this saying? And the second is to Director Huang, and it's a more specific question about your more details, about sharing more details about the practitioners' viewpoint about this liquidity crisis. And thank you very much.
Okay.
他问你的，这问我的。Okay. Oh, you can hear me, right? Okay. Sorry, I'm not sure 100% got your question, but talk about internet, right? As you know, this is talk about our session talk about emerging market economy. But when I talk about my own experience, I talk about the economy scale for my fund. But also for internet, it's also economy scale. China not only emerging market, also the most important feature, one of the most important feature, it's the largest emerging economy in the world. So that means that China will have the largest population of internet users. So when we started SoFund.com, but my thinking was very simple. Because China is a large population of emerging market, everybody needs a housing, so real estate market will boom, right? But we don't, being a kind of high-grade overseas returnees, I don't have money, I cannot become a developer. So internet, on the one hand, it doesn't require much money, and also the sector can attract the venture capital. So we started in this area. And so focus in internet, because the internet also has the largest potential population. So you have a very promising sector, and you don't require lots of investment, and the financing is relatively easier to be available, and also the potential internet user will grow very rapidly. So it turns out our forecast is correct. That China probably have the largest internet user anywhere in the world. So that's why I mentioned SoFund.com is the largest real estate portal in the world. Because we are largest in China. Being the largest in China, you're naturally largest in the world because you are in internet business. So I do think even today, there are lots of opportunities for internet, include actually now they talk about the financial service on internet. I think that will revolutionize the entire financial industry in China.
I think the second question is on liquidity crisis. I wonder if Haizhou can comment briefly.
Okay. I would like to make two small footnotes on the first question. I fully agree with Shan's answer. I mentioned in my presentation that despite the Shanghai Composite Index over the last 3 years came down, if you look at the Shenzhen market, they are doing relatively well. Actually far better. One of the sectors is the internet stocks. China not only in a way that produce Sufang, also has a Tencent, and I think that now, of course, the market has its eye on Alibaba, which is certainly, I think is a fantastic story. So that's the first footnote. The second footnote, I would say that in terms of what contribute to China's growth, I would like to emphasize that finance and financial market, finance theory also play a very important role. I think this is very, very important. I think that we can continue to discuss this. I hope that our MIT Sloan School can continue to come back to educate Chinese audience and help China to develop its own market. So I think that's we can emphasize whatever to whatever level. In terms of the liquidity crisis, happened on this June 19 and the 20s in the China's interbank market. I think that I would like to offer a few observations, and I think that probably you can easily draw your own conclusion about what are the key issues there. One, of course, is really that China developed its own so-called shadow banking problem, and the authorities start to really to deal with that. In Shen's presentation, okay, really his first, in a way, quote failure was really regulation changed, okay? So when you have this major change in regulation, that's going to trigger a chain of event, and that really played a very, very important role. I think that's the first observation I would like to make. Secondly, I think that really that in practitioners' mind, I think many of them are not really prepared for that. In a way, they feel that the easy money or the loose monetary policy probably will be continued. And in a way that over the last few years, if you think about the Chinese banks, virtually everyone tried to grow business. Now you want to take away that part of profit out of those banks. I think that the reaction from different banks differed in a way that certainly there is a certain level of lack of coordination. I think that's very important. The third observation I would like to offer, I think, is really that the role of the regulator, and in particular in this case, the central bank, is very, very important. I think that the central bank did not really, in my view, put a timely disclosure about its policy intention. Maybe here the central bank want to teach everyone a lesson, or give some, a bloody nose, whatever. Maybe there is some embedded so-called constructive ambiguity, but certainly from practitioners' perspective, we don't like that. Okay, in particular in a crisis time, maybe the constructive ambiguity should be developed in a more normal time, but not in a crisis time.
Great. I actually going to ask a couple of questions to the two panelists, and in addition, I'm going to take the liberty and ask my former boss at Goldman Sachs to speak as well. He's in the audience. He hasn't recognized me, but I've recognized him. But I'm going to put him on the spot in a minute. So my question is on the role of financial institutions, and in particular some of the key architectural piece in the Chinese financial system. CDB is the best example, a very unique, very, very important financial institution that Li Shan is now associating himself twice in the past 15 years. And I think he has to share with us what his plans are at the CDB. We've known for a fact that CDB has played a very important role in China in the last 10 years or so. Going forward, how the CDB's development plan in the rest of the world might evolve, if you can comment on that.
Thanks. Yeah, as I mentioned in my presentation, my first job in China was work at China Development Bank. Yeah. That time, the evolution of CDB actually can, in a way, to reflect the historical transformation of China's financial system. And last night we had dinner with speakers and MIT professor, including Bob Merton. I remember Bob said that one advantage of emerging economy like China has because you don't have the historical legacy of the older financial system, you have an opportunity to create a completely new financial system, your finance for the future, right? I think CDB experience probably, is kind of proved his statement. When I joined the CDB like 15 years ago, it's a very high political rank. It's a full minister rank bank, unlike Bank of China, ICB, or vice minister rank. But they are very really a commercial bank. Even in 2008, the Chinese government want to commercialize CDB. They said our shareholding company, but they found out actually lots of so-called policy functions. That means the function which really support the strategic initiative of the country, such like the new urbanization, or such as the go-out strategy of major Chinese companies. All those kind of either involve medium to long-term financing, or there is to finance the area which has so-called market failure. For example, to support the small, medium-sized enterprises, or support or even student scholarship. All this kind of area, the major commercial bank either don't have the ability or the incentive to support or to finance. CDB somehow can play this unique role. So I think that now the government, the new government, I think they must have a serious consideration the position of CDB, whether it's still go down the route of commercialization, or go back to the older days of commercial banking, or keep both. Right? This is a major issue, I think, the leaders, but not only the CDB level, also very top level, think about. But this debate, I think personally I find it very fascinating, because this will involve lots of theoretical thinking as well as a practical consideration in China. This I hope this is called a new development financial institution can be born in this country.
Hi, Joe. I wonder if you can comment a little bit on CIC. You've got Li Shan going back to CDB, and you've got CITIC taking over CL in Hong Kong. Lots of ambition there, and if you can talk about CICC.
CICC is a China-based investment bank. It's actually the first joint venture, not with Morgan Stanley. We started with Morgan Stanley back in 1995. It's the first joint venture investment bank in China. We are still, in a way, a relatively young institution, but we actually we have a plan to grow ourselves internationally. So over the last 3-4 years, we established new offices in London, New York, Singapore, and actually our first office, as Li Shan over, we started in Hong Kong. So really, that's why I said that Hong Kong played really an important role in China's financial market development, because initially the large state-owned enterprise listing, the red chip, some of the red chips, most of them are in H-share were listed in Hong Kong. We are relatively, as I said, a young institution, but we want to become certainly a leading China-based investment bank, hopefully with a growing portion of international business. In terms of revenue from overseas market outside China, we have over 30%. Okay, I think the average for Chinese investment bank, average portion for Chinese investment bank overseas revenue, roughly is about 3%. So there, I think that we are a leader.
Sorry, I want to add a little bit on my comments on CDB, because I want to talk about a little bit about theory. Okay, this thing actually is called in Chinese it's called 开发金融. You may have probably heard about that idea, right? Basically in English, development finance. Development finance started, the concept about more than 100 years ago from Europe. And the World Bank, IMF in a way is a kind of modern institution follow that concept. But in China, right, how to build that kind of development finance, it's a kind of major challenge. I remember 15 years ago when I first joined the CDB, I had a conversation with the Governor Chen Yuan, right, about this. We both agree China should build a market economy, a market-based financial system. We want to move in that direction. But difference in US, you already have such a market base, or you have this tradition for more, including legal framework, everything. But in China, 15 years ago, even today, you don't have this kind of infrastructure in place. So how to, go from the central planning economy, from a government-controlled, owned financial system to a market-based system. So what's the path? Who will be the, make the first move? So actually, we somehow agreed. We think actually the biggest character of Chinese system, political system, is government play a central role, the leading role in resource allocation and everything else, actually. So we needed to, on the one hand, our goal is to establish a market-based system which will reduce the interference from government or unnecessary interference from government. On the other hand, we needed to utilize government power to make that happen. Right? It's kind of, so you create so that's a kind of big challenge for government. You want to create something which at the end to reduce your own power. That's a challenge. So CDB or development finance we're trying to do is to mobilize the government source, which is to help to create markets in China, and then over time to allow other commercial financial institutions to have a market-based playing field. I think that's the idea, which as a student in finance, I found the idea fascinating. But I just joined the CDB recently, so I want to continue to study in this area.
So I heard both panelists mention 15 years. I think China high finance is a young industry of only 15 years old. We are very happy to have a special participant today who witnessed that growth of 15 years. And Zi, if you can make a few comments. Let me introduce briefly. Zi retired as Goldman Sachs China chief a few years back, and he pretty much built a few banks' infrastructure in China. So he is the best person to speak on that topic.
Daniel, that's very kind of you, and hello to everyone. You really put me on the spot. I don't realize that you can recognize me. I thought I become so young, you couldn't even recognize me.
That's in return for all the hard work you put me through.
Well, I left the business in 2005, before anybody can see the financial crisis on the horizon. And I've been in education and conservation affairs ever since, and other than reading and keep myself younger and healthier. So I came really as a student to listen to all of you, from all of you, and to see what's going on today in the world of finance, which I couldn't even recognize. So I don't know. And my dear colleague at Goldman Sachs, Shan Li, keep making waves since year 2005. The good things I hear from Shan Li is really, and he's keeping, despite the failures and glories, he's keeping trying to improve the world, change the world, while most of the finance is far away from real life and the real world. So I couldn't even understand what the professor was talking about this morning. So I didn't really have much to offer. I'm here as a student. And and I do have one person to recommend. If you guys are interested about real life VC, here's my friend Michael Kwong. He's a very special guy. And as I think about it, it's all about, smart and in theory. When you have a direction, the rest of it is all about execution. If you want to hear about execution, here, let Michael, please.
Sorry. I was going to ask a question. My first investment in China is 1989, so I've been through. Now, Mr. Huang, you said majority of Chinese stock market players are retail investors. It's been developed for the last 20 years. Are you worried? And secondly is, I think we talk about the finance of future, but the problem of finance of future is the money is not going to the real economy. OT series, that I think today the volume of all stock exchanges you add up together is probably a few percentage of all the money of either in what do you call currency market or different hedge funds. So as a Chinese institution, as China liquidity and financing become very, very important, we only have 2,000 companies listed versus 20,000 in the United States. What do you think the future of Chinese government financing should be? I really like, as a VC, that I think exit is very, very important, and having company continue to have financing very important. So I'd like to hear actually all of you. Thank you.
Okay, thanks for that important question. Two questions, actually. Let me start with the second one first. I think that finance, as I said, played a very important role for China's growth. I believe in that. I think that in the future, if we talk about the finance for the future, financial market will be playing an increasingly more important role in China's own development. Currently, I think that you are right. If you think about the composition of China's financial system, roughly about 90% of the asset is really in the hand of the banks. Everything else, securities, broker and invsurance, whatever, investment banking, venture capital, whatever you count it together, account for less than 10%. Okay, I think that ratio is likely to change dramatically over the next 5 to 10 years. That ratio probably could raise from currently below 10% to 20-30% in next 10 years or so. Because I believe that there are two major reforms that will push that that ratio to a much higher levels. One, of course, is the so-called interest rate liberalization. If you really want to to answer part of your question, which actually contains so many elements, if you really want to see, for example, that money goes to the real sector, you need to get the interest rate right. Okay, I think that if interest rate is not right, I think that you probably could easily fuel speculation in some sectors, but not really for the whole economy. I think that so interest rate liberalization holds the key. I would not be surprised to see substantial progress over the next 3 years. I think that roughly, in my view, over the next 3 years or so, interest liberalization probably will complete its course. Okay. The second important driver is so-called renminbi internationalization, or related to that is capital account reform, to basically integrate China's own market with the rest of the world. So far, that part, the gate is controlled. Okay, probably there's too much control, in my view. So with that kind of reform to be implemented, probably over the next 3 to 5 years also, I believe that the China's market will be even more integrated with the rest of the world. So companies can easily find a way to list in China or abroad. Or basically, foreign companies can also be listed in Shanghai or in Shenzhen. So I think the number of the listing companies probably can go easily from 2,000. You can multiply by 10, or maybe 5 or 10 over the next 5 to 10 years. In terms of your first question, whether I'm concerned about the high portion of retail investors in China's market, I think that's is related to the development stage. I think we are already seeing progress of increasing ratio of institutional investors. I think that that will continue to go up, but that's also related to the lack of development in some elements of infrastructure, interest rate liberalization, capital account liberalization, and also financial infrastructure. I think that if we have more companies to be listed and we have a market that become more integrated, more efficient, I believe that the institutional investors will increasingly play even more important role.
So we just had the privilege of listening to two practitioners expressing their passion about the business and how things will evolve. We also had opportunity to listen to a ex-practitioner who witnessed the growth of China high finance, but now spending his time on education. So I think the solution is more education. And Dean, I think all hope is on you and the school to recruit more Chinese students, train them well, and send them back. But hopefully with a discount on tuition fees. Thank you very much. Thank you.